First Republic Bank has become the second largest bank failure in U.S. history. Regulators have seized the bank, sold off most of its assets to J.P. Morgan Chase in a rescue deal as America's banking crisis flares up again.
Maybe, hopefully, the end of what has been a crisis of confidence in the banking sector.
Shares of PacWest and Western Alliance tumbling today.
The U.S. banking industry is in the midst of a crisis, with regional banks experiencing significant volatility in recent days. Shares of regional banks resumed their slide this week after the collapse of First Republic Bank, the third U.S. mid-sized lender to fail in 2 months. Strong fundamentals and sufficient capital levels suggest that these highly volatile moves may be the result of market manipulation. Regulators at both the federal and state levels are taking the situation seriously. Short sellers have raked in $379 million in paper profits from betting against certain regional banks, according to analytics firm Ortex. This increased short-selling activity and volatility have drawn scrutiny from officials and regulators, who are increasingly attentive to the possibility of market manipulation. Despite many regional banks outperforming on first-quarter earnings and demonstrating sound fundamentals, share price swings have not reflected this reality. The shares of Pacific Western Bank, for example, lost more than half their value after the bank announced that it was in talks about strategic options. This news dragged down other regional lenders too. Western Alliance shares were among the most volatile and were down 39% when trading was halted. Financial Times published a report saying the bank was exploring a potential sale, but Western Alliance Bancorp denied the report from the Financial Times and said it was exploring legal options. The report had sent the lender's shares down as much as 61.5% before trading was halted. The American Banking Association has called on the SEC to investigate on significant short sales of banking shares that it says appears to be disconnected from the underlying financial realities. The group also said, "We urge the SEC to consider all its existing tools and to take measures to reduce the avenues for abusive trading practices and restore investor confidence." SEC Chair Gary Gensler has replied to the group's request by saying, "As I've said, in times of increased volatility and uncertainty, the SEC is particularly focused on identifying and prosecuting any form of misconduct that might threaten investors, capital formation, or the markets more broadly." Meanwhile, the California Department of Financial Protection and Innovation said it is focused on identifying, stopping, and remedying any unlawful practices in our markets that violate state law. Short selling is not illegal, but manipulating stock prices, which the SEC defines as the intentional or willful conduct designed to deceive or defraud investors by controlling or artificially affecting stock prices, is illegal. Despite assurances from financial regulators and bankers such as Jamie Dimon saying that the worst of the recent crisis is over and the health of the banking system remains strong, uncertainty continues to pull down the banking industry. As officials and regulators work to identify and address any potential market manipulation, the future of U.S. banking remains uncertain. So what do you think of this banking crisis? Do you think that the traders are manipulating the stock prices and making illegal profits out of it? Let me know in the comments section.